Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. One of the investment challenges that we've been focusing on over the last little while has been the relative allocation between equities and bonds across a portfolio. As we all know, equities are designed to provide that long-term capital growth, while the utilisation of bonds or fixed income is there to provide that defensive buffer in periods of higher market volatility. However, with bond yields and cash rates going to all-time lows and in some instances negative around the world, when you adjust for inflation, in many instances the return that investors are now getting on fixed income assets is now negative. In fact, in our view, the return profile for fixed income is likely to be a lot lower going forward than what we've seen over the last couple of years. So it now begs the question as to whether or not investors should still be thinking about investing in fixed income across a broad-based investment portfolio. From our perspective, the answer is absolutely they should be. We continue to see the defensive characteristics associated with fixed income investments as a really important component part of an overall portfolio framework. And even though we're underweight both the bond and cash allocation across our portfolios, it doesn't mean that investors can't pick up an income generative investment across other parts of their portfolio that sits alongside the investments that they continue to have in fixed income. This can be in defensive alternatives, property and infrastructure, and even equities where you can generate, as I said, a nice stable income over time. So when we think about that from a portfolio framework, the income generative nature of an investment portfolio can still be quite high, even though you may actually be underweight the defensive or fixed income component of a portfolio. As I said, we continue to believe fixed income has a really important role to play in periods of higher market volatility. Yes, we do expect that the return profile from fixed income is going to be lower, and from our perspective, it's one of the key reasons why we're underweight the asset class. Equally, we believe that if bond yields start to move higher, that's going to have a negative capital impact on return. But it doesn't mean that investors can't balance out the need for income across other component parts of their portfolio. And certainly the way that we think about it, that's a really important element associated with having a broad-based diversified strategy, capturing income through your alternatives, capturing it through your property and infrastructure exposure, and capturing it through your equity exposure as well. So even though there are clearly some challenges ahead, we believe for the fixed income sector going forward, as I said, we still believe that it can be an important part of an overall portfolio configuration, and it continues to provide that defensive buffer in periods of higher market volatility. As always, if you have any concerns or queries about your portfolio, please feel free to reach out to any one of our advisors, and we look forward in catching up again soon. Thanks, and bye for now.